Get ready for a new episode of KP Talks Dollars and Cents. Learn financial literacy and get real-time updates on all things housing, finance, and real estate with your host, Kevin Perenio. As an owner and C-level executive for 20 plus years in finance, KP is here to serve you with all of his knowledge and experience. Whether you're a broker, realtor, or just interested in the economy, this is the podcast for you. So let's get started. Here's your host, Kevin Perenio.
Hey, it's KP coming to you live from Corona, California. It is just a little bit past midnight here. It's Tuesday, so hopefully our East Coasters will be waking up soon to a fresh new video. I'm going to post, again, the link for episode 3 from KP Talks Dollars and Cents, the educational video. So definitely subscribe after you click on that link to YouTube and bang that like button. You watch the video. We are here trying to serve and teach financial literacy at scale. That's what originators do best, and I'm trying to serve the originator community and everyone here in this community on LinkedIn. So thank you for the support. All right, let's talk about the fallout from last week. It is still lingering into this week. I'm not just talking about the election. I'm also talking about the CPI report, the inflation report. Is it confirmation of peak inflation, peak this, peak that, peak everything? I'm going to talk about a whole bunch of peaks. And I also get into the Fed and what they're thinking and their rhetoric that's being used as a tool as opposed to what their actual statement says and what the bond market thinks about what the Fed is going to do next, especially after the last report. All right, so let's get into everything. So we had last week, we had a CPI print that came out, and it moved the market. But the Tuesday red wave was supposed to move the market for the midterm election. Well, there wasn't a red wave. And I have a take on this. So I am not getting political. I'm not trying to poke at either party. It may sound like I was just taking a jab at Republicans, and I wasn't. And I'm going to say something else that may sound like I'm taking a jab at Democrats, and I'm not going to do that either. I'm just kind of pointing out facts. I'm trying to remove my emotions and remove the passion and just observe, just look and use my eyeballs. I saw a midterm election that typically an incumbent administration loses one part of either the House or the Senate, so one part of Congress. It's pretty normal, like happens almost every midterm in a first-term election. What I noticed, and again, I don't watch a lot of news, so maybe I'm misinformed, but it felt to me that in D.C., the Biden administration really stayed out of the politics and inserting themselves in this midterm campaign. And that's just what it felt like to me here in Southern California. Again, I don't watch a lot of news. I know some districts that might have felt different, but it felt like this was one of the more local elections we've had in a while where, every election, it mattered who the candidate was and democracy spoke. And I felt like, there were Republicans that won seats in Long Island and New York. It's just crazy to see stuff like that. And then, vice versa. So we still have a pretty divided populace. Senate was retained by Democrats, about a 50-50 split. There's still a Georgia runoff coming with Warnock and Walker set to go head-to-head for that final seat. But, at best it's 50-50 or 51 Democrats. Either way, it doesn't matter because of Vice President Kamala Harris getting the deciding vote on any 50-50 splits. It's still not official whether Republicans have won the House of Representatives, but if so, we've got gridlock in D.C., which is good for business. It's good that they have to come together and compromise like normal people do, like we have to do every day running a business. We don't just get elected and then for 6 years we're good and we don't have to be financially sound or whatever. So hopefully this election is a sign of things to come. Now, of course, the next election in 2 years will be very much a national stage, and a lot of those local elections will get swept up in the national presidential election. So get ready for more ugly politics. So glad that's over. Can't stand politics. But didn't really move the market. The CPI print moved the market. Did it get a confirmation of peak inflation? Well, if you go to the CME tool, which I touched on last week, you can see that instead of a 75 basis point rate hike, for the December 14th meeting is only seen as a 50 basis point rate hike, something like a 80% chance now. And then the February 1st meeting, then after that, is only another quarter. So that gets our top line number at 4.5%. So where does that leave the markets? Well, obviously the market rallied. Some people, like I said last week, think it was a technical bounce or a bear market rally. Price action is a thing. If a market is oversold and the bears were in charge and there's a lot of bearish sentiment and there just weren't as many buyers because everyone was selling and they sold and they sold and they sold. And then technically you got some price action where there just aren't any people left to sell and you have a hint of bad news, boom, the buyers come rushing in, especially if there's a lot of bets laid against the market to be even more bearish, like put options and things like that. And then boom, you have a bounce. But here we are, it's Monday going into Tuesday. We've had a couple trading sessions now since that day. And we didn't retrace all the way back, right? So, sometimes there's just more sellers than buyers or buyers than sellers. And that dictates price action. And over time, those patterns, show up. And that's very similar to what's going on in the housing market. When rates were historically low, at epic all-time low rates, we had a massive amount of demand, huge amount of buyers, and it was overwhelming the sellers in a low supply market. So that forced price action, prices to go up. Now we kind of come back down. Now, what's interesting is we have a lot less buyers because of higher rates and a lot less sellers because sellers don't want to sell into a higher priced property. If they're going to sell, 75% of sellers go buy something else, they would be forced to buy a higher priced property at a higher rate. So price action matters in all of our equity markets. I am not a financial advisor. I am not responsible for your losses, only your profits. But price action matters, and we do talk about that. Okay, so we have 17 more data points between now and the February 1st meeting. And there's a lot of CPIs. Tomorrow is a PPI print that comes out in the morning. That's the Producer Price Index. My video last week, I did talk about PPI coming down in China, which is usually a 1 month to 2 month indicator that PPI will come down here. Maybe we'll start to see it tomorrow morning, or maybe it will be the next PPI report that comes out right around the time of the next Fed meeting. There's actually a CPI print that comes out the day before the next December 14th Fed meeting. And there's also a PCE number that comes out, and I'll talk about in a second. But speaking of China, did we have peak retail sales for China? They had Singles Day last week, which is like $140 billion in retail sales in one day. So that might have been peak retail sales for the Chinese economy. And then we have our Q4 coming up, which is seen as peak retail sales for the U.S. economy. Remember, GDP here is 70% driven by consumer spending. And Q4 is our big peak season, peak time of the year. So peak, lots of peaks going on. Now PCE, this is the Fed's preferred inflation indicator, the personal consumption expenditure. It's different from CPI because CPI is prices from the past data, past rents that are going up still, and home prices are going up still, even though we know that data has been coming down. We know that the list price index for rent has been coming down. It was up as much as 28, 29%, 30% at some point in the last year. It's down to only being up 0.2%. Okay, so the rent lag indicators in CPI are not matching the listing index. And of course, we know that home prices have been coming down according to the Case-Shiller index since May. And that hasn't shown up in the CPI. But the consumption, the immediate consumption, the PCE, I mentioned this last week, and I want to reiterate this point. Matt Soniker over there, he sent me, my boy there, Source Point, he sent me this great thing from JP Morgan where they talked about their estimate as of last week is the PCE is actually under 4%. Those are some examples. They also said that the wage inflation number, which is still high, it's at 4.8%, but it's not at the 6.5%, the wage price spiral we've been talking about, the thing that the Fed has been trying to crush. So JP Morgan Chase is thinking we're under 4% on a PCE. You got the Fed out there talking last week. I'll give you a couple things. Fed Esther George said that they're not done. They repeatedly she's been calling for slower, steadier rates since June. But the Fed has had a consensus to fight inflation. But now you might start to see, especially if job losses start to come out, these weekly jobless reports start to stay elevated, you might see less of that consensus with the Fed. They're starting to come out and say, hey, we shouldn't be talking about pauses. Daly was saying that. You got Harker and Philly saying, 4.5% is kind of a good number. You're starting to see maybe some cracks in that consensus. So we'll watch the data, watch the jobs. Bang that like button down below. Have a good one. Cheers. Hey, it's KP coming to you live from Corona, California. Well, we had an awesome day today. Thank you so much, Dave Savage, Mortgage Coach, co-founder, and now with Sales Boomerang and the team. Together with Sue Woodard, we had an awesome survival guide for the coming market. So look out on the airwaves. It's out there. It's worth a listen. And episode number 4 of KP Talks Dollars and Cents is out. So definitely hit the link down below. I'll post it. Subscribe to my channel. Please do that. And then bang that like button. And we're going to talk about an incredible dinner that I had with Zactus in Nashville, where the former Speaker of the House, Paul Ryan, was with us talking about the Fed, because the Fed's all the news these days. And it's very interesting because I know people are attributing a lot of the ups and downs and the daily market movements to the Fed. And let's talk why that is getting a little bit more important, the Fed's rhetoric, and why it's a little bit more important. I'll tell you why, and I'll give you some insights from a little private dinner that your boy KP was on, and I'm going to share just a little bit of that. But first, let's get to some of the news. Okay, so we had jobless claims come out. So that's new weekly jobless claims. And the number was 200-something thousand around the consensus number. But the important part is that the continuing jobless claims remains elevated. Now, remember, we are talking about the Fed's dual mandate, maximum employment of the economy and price stability, aka inflation control. So we've been at pretty low, record low unemployment. So because of that, and to use the phrase from this dinner that I had at Cane Prime, by the way, for those of you that have never eaten at Cane Prime in Nashville, it is like one of the best restaurants literally in America. I kept calling it Kanye Prime. So I don't know how my brain scrambled that. But in this private room, former Speaker of the House, Paul Ryan, who is now an economics professor at Notre Dame, and also noodles catfish at Lake Texoma, which I used to live in Sherman, Texas, on the border of Texas and Oklahoma. Thought that was pretty cool for a guy from Janesville, Wisconsin. He said that the Fed and Jerome Powell has had it pretty easy because they have a consensus. It's easy to keep raising rates because unemployment is low and inflation is at record high. But that consensus amongst the Fed board and all the members, especially the voting members, will start to fracture. And here's why. You got bulls, right? And bears in the stock market. You got doves and you got hawks on the Fed board. A hawk, which is in one of my KP Talks videos, we talked about hawks. Hawks are inflation hawks. They want to raise rates. They want to make sure we get on top of it. Let everyone go bankruptcy. We'll just figure it out later. All that kind of stuff, right? So Dallas Fed President James Bullard is a hawk. And he came out and had some comments today saying, we got to get the terminal rate, which is the end rate of where this Fed rate hikes will go, which currently we're at 375 to 4, right? Remember, we started this thing at 0 to 25. We're now at 375 to 4. He's like, we're going to be from 5 to 7%. So, I know a lot of people are, attributing today's market movement to those comments, and initially that was the case. But don't forget, our bond market, if you look at the 10-year Treasury, has been selling off for 6 straight days. It's way oversold. So we were kind of due for a bounce back. So just like when you had some news came out, 5-6 sessions ago of less than expected CPI inflation and this PPI inflation, sometimes when you get oversold and the RSI charts show that you're oversold, that's the relative strength indicator on these technical charts. It doesn't take much to okay, let's just retrace back, a little reversion to the mean. We see it all the time, stocks, bonds, everything, right? So these comments by Bullard basically got the market to kind of come back in. So rates got a little worse, yields went up on the 10-year. Now, they didn't stay elevated. The market actually fought back because the math, data, science, and facts continue to take over. We continue to remember that even though we've come down 55 basis points on the 10-year, that even though we've come down from that moment, I guess, when the CPI report came out. And that's a big move for the Treasury. That move was oversold, and it was due to come back. But even though we came down that much, we still bounced back a little bit. And some of that has to do with, remember, inflation may have peaked, and we may have another 16 data points between now and February. CPIs, PPIs, PCEs, all this stuff coming out. Rent growth, all these different factors. We may have this data come out that continues to show that inflation is rolling over, aka getting lower. But do we have a growth scare? Do we have the economy looking at a recession? You look at the 10-2 inversion, right? They call that the yield curve inverting, which is a sign of potential recession in the future. Don't know when. Usually within 18 months of the yield curve inversion between the 10 and the 2, you have a recession. 18 months. Now we've had an inverted yield curve for a while. But again, if employment starts to crack, okay, you start to have people lose jobs, like 1.5 million continuing jobless claims. Even though we have 10 million job openings, they don't all marry up, right? Those 10 million jobs could be in, services, places. These people being let go from Twitter, half the workforce, maybe they don't want to go wait tables. They don't want a real job, right? They want the cushy white collar job. All the stuff that you're seeing in the headlines of people being let go, it may not be an exact match, a white collar job versus a blue collar job. Did you know that truck drivers is the most common job in 29 states? 29 states. Think about that. If we do have less growth, we're in Q4. This is when people do their holiday shopping right now. You just saw the 1.6 million workforce of Amazon continuing to announce layoffs. If they continue, which by the way, they have trucks that have no drivers for like 3 years. I've been going from Phoenix to Dallas late night. I go out, I make this run every now and then. I go from here in Corona sometimes on Thursdays out to the Palm Desert area, and I see these trucks. You see them out there. There's these driverless trucks. That job being automated out of existence, slowing growth, peak retail sales in Q4 coming down. Who knows what's going to happen in the first quarter or two? So you've got these hawks of inflation like Bullard that's saying, man, let's just get this inflation under control. I don't really care what happens. But you have doves. You have doves out there that when there's less of a consensus, as former House Speaker Paul Ryan says, who, by the way, is on the board, Perry Steiner, CEO of Zactus, who put together 7 great companies. Credit Plus was one of them, one of our big credit vendors. Greg Holmes, shout out to Greg Holmes, G. Holmes out there, their chief revenue officer. At this dinner, they said this consensus that the Fed has had, because it's been easy, because it's all about fighting inflation. When people start to lose jobs, the doves, hey, well, maybe we shouldn't be raising these rates as much as Fed President Bullard is saying, because people are losing jobs, and that's not exactly politically expedient in an election year coming up, because people are now talking national politics about a presidential election. And any of those local elections tied to the presidential election, if we're going into a recession with a job loss recession, that's going to be a problem. I'm not saying that the Fed's board is political, but they are appointees, and there are politics that goes on that board. That consensus will crack. So the comments, the Fed rhetoric of all these members that are coming out and speaking, Harker, Bullard, Mary Daly, Esther George, they start to matter because the consensus will crack as unemployment goes up. Got it? Now, some of these comments have been kabuki theater, okay? Which, if you look up on Google, it says kabuki theater is a great Japanese artistic show with very dramatic effect and acting and costumes. Some of these comments are for dramatic effect. The word kabuki theater, when used in political discourse, means some of this is mostly showmanship and not exactly a lot of content. But as jobs begin to be lost even more, 1.5 million jobs at continuing unemployment claims, these comments actually matter, because they matter because the doves and the hawks will be fighting, and we might see those Fed rates start to come down and pause, and that's when the pivot gets even closer to even a recession and then actual rate cuts. Let me give one more little insight that I heard that I don't think a lot of people caught. A very quick little clip last week from Mary Daly, San Francisco Fed president. She said on CNBC, it was very interesting. She said she doesn't normally disclose her dot on the dot plot. All this talk from all these Fed members has to do with where they think the final rate's going to be. She said in the September Fed meeting, her dot was 5%. Okay? Some of the Fed rhetoric that came out this week said 4.5%. Sufficiently restrictive, right? Remember, that number, that top line terminal rate, that 4.5% or 5%, or as Bullard said today, 5 to 7%, typically has to be higher than the rate of inflation, typically core inflation or the PCE. We're going to watch, we're going to listen. The comments are starting to matter more and more, but nothing matters more than math, data, science, and facts. Have a great weekend. Cheers.
You've been listening to KP Talks Dollars and Cents, a top-rated show for those who want to learn about the economy and mortgage environment. Tune in each week for more episodes, and please leave us a 5-star review on Apple Podcasts and Spotify. Kevin Perenio does not render or offer to render personalized investment or tax advice through KP Talks Dollars and Cents. The information provided is for informational purposes only and does not constitute financial, tax, investment, or legal advice. For more info, follow KP Talks Dollars and Cents on all of our social channels.